earnings for our markets, and let's chat with the management of Chola Investment. And let's look at the fine print. We've got Arul Selvan, the CFO of cholamandalam Investment and Finance Company, joining in on the show right now. Mr. Selvan, great to have you today on ET. Thank you so much for your time. I was just going through your performance, and you've delivered this 22% disbursement growth despite changing your disbursement recognition methodology as well. Should investors now think of 20% plus growth as the new normal?
See, we always keep saying that AUM is the most important criteria, and we stick to our stance that we will certainly deliver the 20 to 23% growth in AUM. And yes, everything seems to be positive, good, and we should, look at this year being one of a good years after a stretch of a little bit of a slow performance in last year. Though it by itself had been a good performance comparatively, but we see this year should be better.
And Mr. Selvan, therefore, hi, this is Harsh here. Would you, just the strength of the AUM growth, if I were to look at that, 4% sequential in a quarter like this, do you therefore get tempted to probably up that 22% loan growth guidance for full year, just with the kind of start you've got?
No, let's go slow. We promise and deliver what we want to do. Let's keep it there for some more time. Let's the monsoon thing settle. Monsoon has turned around and it's showing to be positive, with the deficit coming down drastically. Let it end July, and then the second quarter is crucial for us to establish the growth path. Then we can look at, revisiting, if at all, the numbers. But let's not start off much early, because it's rather good to promise less and deliver more rather than promise more and deliver less.
Wanted to understand, Mr. Selvan, though, funding costs, they've helped your margins in this quarter. But if rates were to reverse, how much of this NIM improvement is really sustainable? And would there then be any risk to your FY27 1.5% credit cost guidance?
Our internal judgment or assessment is that there will not be a rate hike in Q2. There could be a rate hike possibly in H2. Which we are confident that we will be able to sort of manage. So overall, like I was saying yesterday, our cost of funds to average assets would remain at similar levels for the full year. Last year it was a case where the first 2 quarters were high and then the next 2 quarters were low. This year it's going to be the reverse, where the first 2 quarters could be low and then the last 2 quarters could be high. And thankfully, the new products which we are building and which has got good growth legs will have better yield. So at a NIM level, we should still be, at the same level at best, and we can further improve as they grow into the largest share of the AUM.
Sorry, what should lead to that margin increase? If you could just kind of give us that perspective.
I'm saying the new products such as the gold loan, SBPL, etc. They have higher yield. These have higher yield margins.
Exit NIMBY FY27.
Yes, FY27.
What would the exit NIMBY, sir?
I would keep it at same level as what we have been delivering. See, I always prefer to keep where we are and don't want to count the chickens before they hatch. So let it happen.
Yes, typical.
See, there is still some more volatility left in the macroeconomic, so we need to be careful. See, we will have to go steady.
Mr. Selvan, we are assuming that you do anticipate higher gold prices for sure. And that surely, in turn, is going to benefit your business.
Yeah, gold prices will be beneficial, because with the same amount of gold, we will lend, more. And the more we lend, gives us better interest income on that. So it is good. But volatility in gold price is not good, because then it will create certain amount of, stress in the system. So we are careful. We want to be very careful about it. But right now, gold is less than 1% of the portfolio. So that by itself will not be a big game changer, but it will keep growing. And as we move into the subsequent years, we will see that becoming a larger share in the NIM and the profitability.
Credit costs, what's playing out overall industry-wide? Some of the hikes that have come in petrol, diesel, how do you expect the impact to go through the industry?
The price of diesel per se will not impact the credit of the customer. The customer generally passes it on. Maybe there will be 1 or 2 months of intervening delay, but otherwise it gets passed on as long as the price increase is universal. Within the country. The crucial factor would be the availability of diesel. If availability of diesel becomes an issue, then the vehicle cannot run and then there will be no business to earn from. So that would be the one crucial factor. The other one would be the availability of material to transport. If for some reason the underlying transportable material by itself suffers, maybe let's say if in a worst case scenario like the farm produces less, then they were not able to transport, then their earnings get affected. But price increase of diesel is not a impacting item on the credit.
I want to also understand, Mr. Selvan, how is it that you see the used vehicle demand now panning out? And then how is it that you also see where your home loan and LAP disbursements are going to look like going forward as we close in on the fiscal?
I think this year the focus will be more on new vehicles because we are going through the cycle where the replacement cycle is coming into play. So you'll see more traction on the new vehicle, aided by the GST reduction. So people who went in for used vehicle when the GST was high and there was a shift from BS4 to BS6 happened, they moved to used vehicle. Will move back to new vehicles because right now availability of reasonably low vintage used vehicles are coming down of the BS4. So BS6 vehicles will be available in the used market, but that comparatively with the BS6 new, factoring in the GST reduction would be, the price difference would be marginal. So people would prefer new vehicles. This is the trend we are, sort of assuming, and we see that happening. You would see our first quarter also. New vehicle growth has been larger than the used vehicle growth. I think that trend will continue as we move through the year.
Last off, therefore, is there a possibility of a positive bias on the pre-tax ROA guidance that you typically give? Just because asset quality looks strong at this point, credit costs shouldn't be inching up meaningfully, and margins could likely be slightly positive getting into H2.
It will be better than last year full year versus current year full year. You're seeing it in the first quarter. You will see it happen in the subsequent quarters. But I don't want to give a number per se right now, but it will certainly be better than last year is our assessment.
And how does the loan mix evolve, sir? Maybe a couple of years from now, of course, there are these new levers which you're using. What would the loan book mix look like?
Yeah, the loan book mix will progressively, have a lower vehicle finance and a larger mortgage book, and still a smaller new segments, which is like your gold, unsecured, etc. Unsecured, we are conscious that it will be less than 10% of the overall book. Vehicle finance should be in the range of around 50% or marginally lower. Mortgage book all put together, LAP, HL, SBPL, and SME put together should be in the range of around 40 to 45%.
Okay, Mr. Selvan, on that very promising note, we'll let you go. Thanks as always for joining in.
Thank you.